my neighbor has a fire and it impacts my unit. Well, I didn't do anything wrong and I don't want to submit a claim. So your carrier has to cover my unit. Sounds like, why wouldn't they? But my property is not scheduled property on their policy. So they're not going to cover me on the property on the first party basis. So now I get to sue my neighbor to get them to pay for my damage. That is a tough situation.
I'm Denise Haas, and this is Hey Neighbor, the podcast that dives deep into the real-life issues of HOA living, the good, the bad, and the downright complicated. Ladies and gentlemen, welcome to another episode of Hey Neighbor. You know, because we like to talk all things HOA here. And today I'm super excited because this topic, particularly in Colorado, has been a hot one. And Tressa Bishop, who is the Senior Vice President at Alliant Insurance Services, specializing exclusively in community association insurance. She holds the CIRMS designation through CAI, one of 125 or more in the nation, and additional credentials such as her MBA, her CIC, her EBP, her ABC, LMNOP, QRSTUV. Tressa advises boards and managers on risk management, budgeting, and coverage strategy. And I would love to welcome Tressa. I've known her for quite a while. She has handled some of our associations here at Five Keys, some that have been really distressed and insurance costs have been exceptionally high, and been able to take the time to analyze the governing documents, make sure they actually are getting the coverages that they need, and turn them around so that they're moving in the right direction. So with that, welcome, Tressa.
Thank you so much, Denise. It's a pleasure to be here. I'm excited for your podcast venture. I think the voices in this community, we hear a lot of negative things about HOAs and insurance, so we have something in common. But we'll talk a little bit, I'm sure, today about things are on the upswing in a lot of ways. Certainly there's still some challenges, but I'm excited to be here. Thank you.
Okay, so I'm going to stop for just a minute because I kind of teased on all your credentials because people tell me I have the alphabet behind my name. What's the EBP?
It's the CAI Educated Business Partner Distinction. So sometimes I leave that off of signatures, things like that, because if they don't know CAI, the CIRMS designation, the Community Insurance and Risk Management Specialist, that's the big, sort of the biggie. The EBP is just that we know what we're doing. Yeah. That's
so CIRMS for you is like PCAM for me. It's like where we went to write our thesis to get our PhD in our specialty.
Yep.
I love it. All right. Today, we're going to demystify HOA insurance for boards and homeowners. We're going to explain why premiums have risen and hopefully are starting to make a shift to the other side, and what can be controlled. And we're going to give a practical checklist to think about when you're doing your next renewal. All right. Premiums up, down, where are we at?
Again, it depends on where you sit in the marketplace. So we've got, I know that's an easy answer to say. It depends.
There was the insurance answer.
So those associations that are with an admitted carrier. So let's kind of just start. There's a couple different branches of the insurance tree. There's the admitted side, which is we're required as licensed agents and brokers to place business with admitted carriers. They pay into the state guarantee fund. That means if that company were to become financially in peril or become insolvent during the policy term, there are funds at the state level to pay claims for those policyholders. They also have to file their forms and rates with the state, so they can't be as flexible as the non-admitted carriers. They typically have their own claims handling. They, process and pay claims quickly. They're the preferred carriers. We'd love to place everybody with admitted. So those carriers, I'd say those premiums are still on the rise, but not nearly as much as they have been in the last few years.
Okay.
Their biggest challenge right now is the cost of reinsurance. So insurance companies have to carry insurance for their risk because they don't have all the money in the bank for every single association, for example, that they insure. They have insurance on that for any large catastrophic type claims. So admitted carriers are still going up,
Yeah.
but not, we're looking at probably 5 to 7% versus 2 years ago, it was 20 to 30%.
It was incredibly high.
Mm-hmm.
I mean,
And then-
it made the news
Yep.
multiple times. People thinking that the boards had done something wrong when in fact they didn't. Along with having admitted carriers, non-admitted carriers, are non-admitted carriers, are they like the Lloyds of London?
That's whatever. Yes, that is and Lloyd's is the Lloyd's syndicate. So the different companies that actually are in London that do take the higher risk properties, things like that. It's not just Lloyd's, but yes, there are many carriers, even your everyday carrier, such as a Travelers or a Liberty Mutual, for example. They have non-admitted sides of their company, right? So
That's interesting.
yeah. So, but the non-admitted carriers don't pay into the state guarantee fund. So we do watch their financials make sure that they're on good footing. And then number 2 is they don't have to file those forms and rates with the state. They can be a little more flexible, meaning they can throw something at the wall and see if it sticks, see if it can sell. They don't have to do an underwriting worksheet necessarily to get to their premium. They say, well, let's try this. And then if it's not taken, well, let's try that. So those premiums year over year, there's a lot more competition in that space right now. So those premiums we're seeing those come down generally, depending on what the limit of insurance needed is, things like that. But anywhere from a flat to a 30 to 40% reduction because you've got more carriers competing in that space for that business. However, again, as I said at the beginning, we are supposed to place business with admitted carriers. We always look to do that. But so from a rate perspective, I say it depends, and that's why. But it's good news on the horizon. I really do believe.
So the admitted carrier versus non-admitted carrier, and I'm not meaning to harp on it, but there is one more clarification I want to make. So in an association's declarations is where the stipulations are in regards to insurance and what you are given to go, Tressa, I have this association. They need to meet these guidelines, the A-rated, AAA rated, B full alphabet thing.
Yeah.
Is that also spec'd in the governing documents sometimes?
The admitted versus non-admitted is not typically mentioned at all. What is mentioned are no less than an A rated or B or better. So the financial ratings, A++, A+, that kind of, and then go down into B. We don't place business with B rated carriers. We don't. A minus, you might have a carrier that is an A minus. Doesn't mean that there's problems, but we do watch. In the last 10 years, I've replaced 2 policies for associations that the carrier went from an A to an A minus, then to a B plus. We didn't want to stick around to see, were they going to slip any further? So midterm, we replaced those policies sort of in the background. We notified the association, but it didn't cost them any more money. We, worked that out to make sure that there wasn't going to be a problem with claims payments down the road.
And associations typically, I would like to say 99.9% of the time, won't violate trying to get that type of AAA plus rating because the declaration is speccing that. But when this transition of insurance issues started happening, is it 3 years ago?
4, yep.
3 or 4 years ago. Did that cause associations to have to think a little bit differently or actually consider that?
Yeah, one of the biggest changes, again, there's many, so I'm going to simplify this just for the sake of our time here. But one of the biggest changes to go from an admitted carrier to a non-admitted, and this is sometimes spec'd in the declaration, is the blanket coverage. So blanket coverage in the property policy or hazard insurance, sometimes it's listed as that in the declaration. Blanket insurance, the idea behind it, and again, there are different types in different commercial insurance, but for associations specifically, say you have 5 buildings in the community. There's $1 million each for replacement costs, just for simplification. And so you have a $5 million total limit of insurance. So 5 buildings, $1 million each, $5 million total insurable value. If you have a blanket policy form, that kind of goes over that $5 million. So if one of those buildings were to be demolished in a fire, but it really takes $1.4 million to rebuild it at the time of loss, you have the blanket. So you have the full $5 million for that $1 million schedule, building that on the statement of values, it shows $1 million, but it's 1.4. You can draw from that full $5 million with that blanket form. Non-admitted carriers do not typically offer blanket. There are a few exceptions to every rule, right? So there might be a carrier out there that does offer blanket, but we will ask then, so you're losing that flexibility. We will ask for margin clause, which is an additional 10, 20, 30% on top of each of those $1 million scheduled limits. Some carriers, you can get it, you can purchase that, and then some you can't. And it really does depend on their spread of risk. And there's more behind the scenes on the underwriting side, but that's a way that we try to combat that. We need to ask for that, document that. Sometimes we can get it and sometimes we can't. It's been less available recently, I will say. So that is something, that blanket limit. If you've got 2 carriers and you have an admitted option, maybe it's $20,000 higher than the non-admitted option, you have to consider if there's a loss. People only care about insurance when they pay the premium and then there's a claim. So if you think fast forward to claim time, if you have that blanket, that's going to be very helpful in case of a total loss to a building.
Blanket different than umbrella?
Correct. Umbrella is on the liability side. Mm-hmm. So the blanket limit is on the property coverage, and the umbrella, people ask, well, can we use that $10 million umbrella for the property? Only those policies that are liability that are under that umbrella are able to access those limits.
It's a good distinction, though, to know and understand.
Mm-hmm. Yep.
So, again, back to what changed. What created, I won't speak on it, I'll let you speak on it. What created, oh my gosh, and now we're into some very weird things being asked to be changed for associations to be able to get insurance. So we'll do that the second part, but the first part. What changed 4 years ago?
So we blame a lot on COVID, but it really did impact the insurance world. There's been a few that we're coming out of what's called a hard market. So with COVID, you think about the shutdown of many parts of the world, right? And society in some ways, and the ability to get goods and services, right? So skilled labor, materials, the cost of materials after a catastrophic loss. And the natural disasters didn't wait during COVID. So you have all of those things. We can all remember the news and all of the ships offshore, off of California. Like, yes. I know the material's out there, or the cars are out there, or whatever. That all feeds into the cost of replacing damaged property or lost property due to insurable events. So carriers, they might have thought it was going to cost $1 million to replace a building if there was a fire, but it might have been $1.8 million because the cost of skilled labor, we were paying people to stay home in the United States, right? So the cost of getting people to then come back out and actually do the jobs that needed to be done, and also the cost of the drywall and things like that, lumber, those are all things that drove the cost of that reconstruction. And then the cost of reinsurance, the insurance that the insurance companies have to carry. When reinsurers, would say, yeah, I'll sell you some reinsurance for these projects or this region, they hope they never have to pay it. They just would like to collect that money. But with all of the large catastrophic losses, fires, wildfires, hurricanes, tornadoes, we've had all of those, often in the last several years. Those reinsurance carriers are having to pay out where they maybe hadn't had to the 3 or 4 years prior to that. So those costs for the carriers have also increased double digits. And so carriers they're money making companies, right? They're for-profit entities. They have shareholders, or they might be a mutual, but they have folks who, are looking for them to not be in the red every year. So they've got to balance, just like a business owner, you've got to balance your costs versus your income.
Sure. I know when I've sat at board meetings and I've explained, anytime there's a catastrophic loss, you need to realize how this impacts you. Because while you think this isn't anything that bothers me because that's thousands of miles away, it does. What about how that impacted and narrowed the market for people? Let's talk Colorado, because you and I are incredibly close to that situation. We had the Marshall Fire. We are notoriously known for hail. But then we get all these claims, and the claims that happen extraneously on the rim to us, the Maui fire, the Florida stuff, the hurricanes, stuff that happening in the world that comes back in. And now we're trying to go back after insurance, and our market is even narrower for associations specifically. What creates that?
So the companies, there are very few just regional companies, right? There are a few regional carriers who really have, their exposure is very narrow. It's very small. Most are either national or international companies. So again, they do look at different classes of business, and they try to adjust their pricing and not, maybe kill every one of their classes of business. But associations, especially, again, Colorado, we've got wildfire issues. We've got, as you mentioned, the hail. We can all name the dates off the top of our head of the major hailstorms for years, from like 2015 and on. And so in that respect, you think about the roofing situation, and like how many roofs, deductibles have followed the trends of the higher losses paid out and all of that. But with regard to the insurance availability and affordability, the national and international events do impact it, again, because of the reinsurance, again, labor, materials, all of that. The labor costs over in the Middle East, if something happened, isn't going to impact our labor. But certainly drywall that's brought overseas, things like that, those costs are going to impact. But the associations that have never had a claim, maybe they even replace their own roofs proactively. Like, there are a couple of those unicorns out there waiting for hailstorms to take their roof. But those communities, when they're hit hard, it is a gut punch. They're like, we've done everything right. We've had no claims. We're just caught in this. Can we self-insure? We're the perfect community. So we do hear that too. But does that answer your question?
It does. Actually, you brought a phrasing in that I do want you to talk about because of what's happened with the industry, what we're seeing a lot right now. And actually, you're dealing with it in one of our communities. They had their governing documents rewritten to shift some of the insurance responsibility to the homeowners. I think that I've heard that's becoming more common right now. It's like a little blip of a trend. So you can go, I don't care which order you go. I want you to talk about a community self-insuring and what that actually really means, because we have some people or communities who have gotten brave about it. And then we've had the communities who are going more toward let's shift some of that responsibility. Can you talk about both of those?
Absolutely. So we'll talk about the way you keep the community kind of looking the same as it was before. Maybe the governing documents common, in Colorado, if you have let's talk just vertical boundaries. So townhome style buildings, but the association insures the buildings because that's the way that the documents were written. So those associations, many of those state that the association will ensure that the townhome units or the condo units, as well as the interior of the building and the structure, but the interior to the original specification, the way the first unit was turned over by the declarant to the first owner, not including owner upgrades. We call that single entity or original specification coverage. So that's very common. I mean, any community written, that was established in the 80s or 90s, that's usually what we saw. So with that, it's hard to know, really hard to know interior wise, how much we should be insuring for. We have some great tools on hand, and we do use those. Ultimately, it's up to the board to set the limits of insurance. Our state statute doesn't require an appraisal. Some governing documents say you may have an appraisal every 3 years, but no requirement. So that's something that on the legislative side could be something that could be looked at some point. So those associations now are saying, how do we stop the bleeding on the association's insurance? What levers can we pull to impact this? Well, deductibles increasing is one, but you can only go so high before you put an undue burden on the owners. If there's common area property that's damaged, that's then going to be a big expense to the association. But then the interior unit coverage, if you don't have any horizontal boundaries between units, there's nobody upstairs neighbor or downstairs neighbor, because that's statutorily driven, you can look to change the declaration, make an amendment with your legal counsel to say, okay, the association is now only going to cover, we call it bare walls. So the unfinished surfaces of the walls, floors, and ceilings of the unit. Nothing else inside. No kitchen cabinets, no bath fixtures. That allows us to say, okay, for the building shell, perimeter, the interior walls with the plumbing and electric and drywall only.
So turn the building upside down, whatever shakes out, we're not covering.
And also we're not covering the finished flooring, the light fixtures, the kitchen.
Oh, so
cabinets,
even that analogy doesn't work perfectly.
Truly getting down to bare walls.
Okay.
So that is a way, that's a lever that can be pulled. But again, you need to make sure the communication with the owners is clear, often, and upfront, because that policy, as soon as that is in effect, that amendment takes place, if you need the owner approval, 67%, or whether it can be done by board resolution. I've seen it done both ways.
Ooh.
You need to make sure that if there's a loss after that, the owners have gotten their insurance up to par with that full interior finish. So that's one lever that an association can pull.
Okay.
We've been at, if you have horizontal boundaries and you're a post July 1st, 1992 community in Colorado, you have to follow that information in Kiowa. Sometimes I hear different interpretations by adjusters and attorneys, but as we sit here today, it's not clear whether or not it's truly bare walls in a condo, because they talk about unfinished flooring, walls and that kind of thing.
Right.
But they don't mention kitchen cabinets and bath fixtures and things like that. Just talks about owner upgrades. So my hope is that will improve in the next year, or maybe.
Or that managers, if you're listening, when you're having your governing documents rewritten, I always recommend, and this was a tip I got from Tressa, who said, hey, why don't you let me take a look at that to make sure that it's written to make it legible so everybody understands what needs to happen and you actually have a solid document that can be followed going forward.
For the adjusters on both sides, the HO6 adjuster and the association adjuster, and it makes everyone's life easier. And people aren't upset because their interpretation was different as the owner versus the board. So moving on to a more aggressive change that we're seeing happen in some communities is the going from the association master policy on the buildings to having each owner individually insure their unit, their attached unit, as a single family home, basically. So if you have a patio homes, like true patio homes with single unit buildings, that's fairly easy to do. You still have to work with the attorney. You still have to make sure that you're letting people know what their responsibility is, because there's not a shared wall in that case. To move from where there's duplexes, triplex, 3, 4, 5 units attached, and do that, it can be done. You really have to think through the shared wall situation, the shared roof line situation, and that sort of thing. So we've seen where this has been done successfully, with a lot of thought. You have to, changing that type of thing, you typically would also need to notify the mortgage holders because you're fundamentally changing what that owner is required to obtain. And they need to be aware and approve that, as well as we've seen where there's been a large fire or a hail claim within those communities. So tricky part is nobody thinks this will ever happen to them, but you have a next door neighbor. So you've moved to where I'm in a 3-unit building. I'm the middle unit. I've got my insurance for a single family home for my unit, an HO3 policy. And my neighbor has a fire and it impacts my unit. Well, I didn't do anything wrong and I don't want to submit a claim. So your carrier has to cover my unit. Sounds like, why wouldn't they? But my property is not scheduled property on their policy. So they're not going to cover me on the property on the first party basis. They might cover under the liability, but probably only if my carrier subrogates against their carrier. And again, depending on if that person even has insurance, they may not. So now I get to sue my neighbor to get them to pay for my damage. That is a tough situation. The other thing is the hail, because we mentioned, obviously Colorado, the hail-prone state. If you have a community of, say you have 80 units in the townhome community, you've changed so the owners are responsible for their insurance. Didn't change the maintenance responsibility on the buildings though. Let's have that little asterisk there. And so the hail happens and people have their carriers come out and inspect, most of them agree that the roofs are totaled. You have a couple that say, nope, your roof's fine, not covering that, not a covered claim. And a couple that they don't have any leaks and they're not submitting a claim to their carrier.
Yeah.
Okay. That's a whole mix that you can think about all the things that could go wrong. But then you also have 20 roofers in your community for an extended period of time. We know how it is in a community where there's one roofing contractor that's hired, but you can picture some of the things that might happen when you have that situation. And then one other thing on that, a neighbor who didn't submit a claim, didn't have any issues, didn't have any leaks. Fast forward 18 months, they have some leaks. HOA, you need to maintain my roof because that's your responsibility. And now you get a fight with them over the fact that it was probably needed to be replaced because of the hail loss and it's not a maintenance issue. And it's just going to be, you got to think about those legal costs down the road and all the other things. So I think you're ready to move on. I think you're
No. What you're creating is a lot of additional questions in my head. And I'm going, oh my gosh, we could have 6 interviews, you and I. That is true. So that scenario is the one where the association has rewritten the declarations and pushed more responsibility to the homeowners. But what's self-insure? And how do you prepare for that?
Yes. So when we say, some associations call that what I just described as self-insurance. That's not what that is. That is single family home insurance for each owner. When we talk about having a community wanting to self-insure, they actually want to, instead of paying these exorbitant premiums, they want to be able to put them in the bank for the rainy day so that if something happens, they have the funds. They don't need a carrier. Why would we need somebody? But the reality of that idea is, I love the sort of buckle down and do it ourselves kind of idea, but you will not have anyone lending in that community, right? So number one, lenders that wouldn't fly. You have to be very financially sound and have a lot of capital resource put away and earmarked to be your own insurance carrier. So there are captives and other vehicles. But again, even structuring a captive, which is basically being your own insurance carrier, but you have someone managing that, and maybe you find a group of HOAs across the country. So there's a good spread of risk. If they're all in the Denver area or they're all in the mountains or that kind of thing, you may not be a big enough spread of risk you might use all your funds on one major catastrophic event. So, but really the lender issue is the biggest thing on the HOA side for truly like a self-insurance type of thing for an association. And then of course there's some states do allow that. It's written into statute. Florida is one, but it's very specific as to what's allowed, available. how that would work. And I don't know of any communities who have actually successfully done the self-insurance thing.
Well, that lending piece is huge. I have to tell you quite honestly, I did not think of it from that perspective. So that was good information for me. If this conversation of Hey Neighbor is making you wish you had a better HOA community, check out my company, 5 Keys, an HOA community management company dedicated to unlocking the full potential of every HOA community we manage. Find out more about our 5 Keys to Community Success at 5keyscm.com. Now, back to the show. Talk to me a little bit about the HO6, HO3 policy. I would say let's go to HO6 first.
Mm-hmm.
So this is a common question. Homeowners, usually when we're in a meeting, we say, okay, insurance is renewed. Here's your certificate of insurance for the association. Take this to your insurance carrier to have them help you. They really want us as a manager to tell them what they need to do. And we constantly are pushing back saying, you have to have your insurance provider handle that for you because we're not in your situation. We don't know the specifics for you. But where this commonly happens, and I see this, I think I just had this conversation yesterday, was around a special assessment. And through the years of my far too long doing this, we have issued some special assessments that have been for either a hail claim deductible or an insurance loss. And people call back and they're like, okay, my carrier's not going to cover this. And they're upset because either it's the date of the letter or the date of the loss, or they don't like how it's worded. What is some really good tips that homeowners can take from this? Because this is where they commonly use it, is for this loss assessment coverage. Do you have any tips around that for the homeowners?
Yeah, there's a lot of changes on the HO6 landscape. So with carriers, and they're all different. There's no one set rule or requirement for the HO6 carriers, which is problematic. Talk about some of the problems and then talk about what I think a good solution may be. It would be great if homeowners could get behind this in a way, and I'll talk about that in a moment. But
okay,
so the helping a community through a special assessment now for us, a storm from last May, year ago May. So again, special assessment was just made. I wasn't the broker at the time of the loss. We joined them in the spring this year. You think about the date of loss is May 2024. The special assessment is late July 2025. So the date of that special assessment goes to the owner of the property now. So anyone who moved in who wasn't an owner,
they have the special assessment.
Before,
right.
They have a coverage gap because HO6 policies typically either have the trigger for the HO6, as you mentioned, is the date of the storm, the date of the storm that caused the loss, which May 2024, and then the date of the special assessment, July 2025. So those two dates are important. Some carriers, they want to be the same policy term in order for it to be covered. Well, how do you line that up? Even if you're an astute insurance buyer, that's not reasonable. That's not reasonable at all. So again, those policies, that's a problem. I have seen, and then I've heard at some of the town hall meetings before the special assessments pass, someone saying, well, now go get more HO6 loss assessment coverage before the special assessment comes out next week.
I've heard that too.
Sounds great. And it used to work, to be honest with you. I'd say back in 2016, we saw carriers, people could increase it. Then the special assessment came through and they got the coverage. Well, carriers got savvy to that. So there's kind of a walkout date, right? If you request the increase and then you put a claim in within 30, 60, 90 days, not going to be covered because they know what you're trying to do, especially if the hail date was, or the storm date was way past or way in the background. So those dates are problematic. One of the things, I was talking to a friend who is an attorney, And he reminded me of something Minnesota passed, I believe is in 2023, statutorily, that HO6 carriers must use the date of the special assessment as their date to pay a claim for loss assessment. If we could get something like that in Colorado, that would really help out those owners who are stuck with a special assessment. They didn't even live in the community, or maybe they've changed carriers because they had a 100% increase from their last carrier, or they got dropped because they have a teenage driver and it was all related to their policy.
Can the current homeowner go back to the previous owner who owned at that time to have them submit a claim?
That owner that owned at the time, May 2024 in my example, is not being assessed. There's not a loss for them to have covered, right? Because the special assessment is to the current owner. It's not transferable to the past owner. And so they would not have coverage under that. What we tell managers and boards, as soon as you know that there is a chance that you will have a claim, you need to put that in the status letter. It seems like you're being alarmist. However, the realtor and the buyer seller, they need to be able to work that out at closing so that somebody knows, okay, I may have a special assessment coming down the pike. Oh yeah, they gave me a $10,000 credit at closing. Now they still may not remember that when they get the bill from a special assessment, but that is a way that if somebody's selling and they need to get out of Dodge, they can at least make that owner whole for something that they're not going to probably have coverage for, or hold it next to escrow until that happens. And then if they do have coverage because their carrier covers it, then that goes back to the seller.
That is really good feedback. And thank you for sharing that, because I think you just cleared up a lot of things for a lot of people out there.
Good.
Okay. Only because we are going to come back and do this some more, because I have so many more questions that aren't even on my sheet today. But every time I talk to you, I want more. But let's do a little Tressa's top 3 tips. How to avoid gaps between the master policy and unit policies.
Okay, I'm doing this tonight for a 406 unit community.
You go, girl.
It's super important. But I would say top 3 tips how to avoid a gap. Well, the broker for the association should be providing documentation as far as what is the deductible, what may I be responsible for that in the coming year, right? At renewal, we need that information. In my opinion, again, other people might have other opinions. I don't think that should be coming from the board, the management company, or the manager. I think that should be coming from your insurance broker, because again, if it's accidentally the wrong information and then there's a problem later, they have errors and omissions insurance for being an insurance broker or agent. You as a manager or management company, you can't play insurance agent and get away with it on your professional liability policy, your errors and omissions.
Right.
Let the experts be the experts. So that's one. So notification of what those deductibles are. Making sure that I as an owner...
Does the certificate of insurance work for that?
The certificate of insurance can be passed along, but no, I don't think that has enough information on it, to be honest with you.
Okay.
I don't think that it's reasonable for an owner to understand even what if it says wind hail deductible 5%, they don't know what the heck that means. So they need something more descriptive and more English, maybe if you will. So I do think that's something that the broker should be providing every year at renewal. So making sure that as an owner, you don't have a gap if you know that you have at least the amount for the all other peril deductible on your coverage A, your building or dwelling portion, because loss assessment coverage, you need a certain amount, and that should also be disclosed. Loss assessment is typically used when all owners are assessed. Coverage A, building or dwelling coverage, is when less than all owners are assessed. So if I had a frozen pipe, in my unit.
Specific to a unit or a set of units?
Yeah, yes.
Okay.
Less than all owners, because again, there's specific language on that policy form for loss assessment. So number one, disclosure of the deductibles that they may be responsible for. And then making sure that the HO6 policy has up to those limits. Water backup or sewer drain backup coverage on the unit owner's coverage is huge and not often carried. It's an optional coverage. It's usually about $16 a year for that coverage. So if you're responsible for that $25,000 deductible because you had your hot water heater decided to, to have a problem, or you had a backup in your unit, and you don't carry that optional coverage, your HO6 carrier may not pay up to that $25,000 deductible because you just don't have the coverage. Or if you only have $10,000 of water backup, but the deductible is $25,000 for the association and the loss is up to or over that amount, I've seen where the owner is out $15,000 because they didn't have a high enough water backup limit. So if they say, well, my policy only offers $10,000, I'd be changing carriers because $15,000 is a big amount to just stay with a carrier that doesn't meet this year's deductible requirements. So that deductible is really where we see the gap.
Ooh, that's good information.
I don't know if that was 3, but that's really the
No,
top. Yeah.
I don't care. That was all good. Makes me want to go home and check my own policy. And I'm a single family homeowner. If you could help a board be more proficient this year, what is one thing you would want them to know? So
I was just discussing this on an editorial committee for a CAI chapter, but I would love for, there's different decades that different associations have different issues. So year of construction, I mean. So
that is a very true statement. That's really good.
So I'm writing something on that. So to kind of look, okay, if your association is built between 1970 and 1990, and you're actually 70 to 80 and then 80 to 90 is really, there's unique situations there. But I would love for associations to know that even though you do not have maintenance responsibility inside of the units, you need to be keeping documentation on building elements that are inside of units. It's not easy, but it's data gathering and it's legacy information that can help your broker help you when it's time to shop for insurance. The more detailed information we can provide to carriers, the more comfortable they get giving an additional credit. So underwriters can have up to a 30% discretionary credit for an account. We're not leaving money on the table. So that's why I ask so many darn questions. And I know I gather a lot of data when I'm shopping for an association, especially the first time. But we really want to put your best foot forward. It would be like selling your house and just putting on MLS, but not doing Zillow, Realtor, all the things that social media now sells houses. So same idea in the marketing process. We don't just click a few buttons and get a quote. That's not how it works in commercial insurance. So I think that I would hope that boards would understand that there is a need for legacy building and unit data, that it is important to sometimes undertake a project that impacts unit owners' units for the good of the community. And yes, you can is my answer, because I've seen it done. You have to work with legal counsel. We have to look at the governing documents. And the communication to owners in a town hall meeting, do not block out your insurance broker and your attorney for those. Don't run those on your own. It's not going to go well, and they're going to be like this when you really do need it done. So that would be probably the biggest thing. And then loss control recommendations are not optional. I've had, community where the loss control recommendations had some things that had to be done, and they're like, we're just not going to do it. Can you just find us a new carrier? So if you get canceled for that and you have to go find a new carrier, we have to disclose why you're canceled by this carrier. They might have more recommendations and it'll be more expensive to do it with the next carrier. And now you have an off-cycle date with maybe your general liability from your umbrella, which is not acceptable for those carriers. So there's a lot more problems. Work with someone who specializes in whatever niche of insurance you're purchasing, because the body of knowledge, the ease of doing business, it can pay dividends.
So, Tressa, I love you. Thank you so much for coming on. I would love it if you would be willing to come back again and have us do another 45 minutes to an hour, because I would like if you would come back and talk about what's happening in the market with now insurance carriers are getting more particular about what we're doing and improvements that we need to make before they will even insure, such as associations have to get rid of grills, change out breakers, aluminum wiring. Aluminum wiring is kind of an old one, but I just heard one earlier this week about now it's how we track leases. So I would love it if we could come back and have some more conversation. But for right now, I want to say thank you. You gave some really important things for boards and homeowners to do. And if they're not paying attention to it, I'm sorry, because we were here to tell you first to really move in a different direction and pay attention. Protect yourself. You deserve it. You pay a lot of money to an insurance company. It's not if, it's when you need it, because eventually you will need it at some point in your life. And I want you to be able to get the best out of it that you can. You've paid all that money for all those years. When you need it, you want it to do everything that it's cracked up to do.
Absolutely.
So thanks, Tressa.
Thank you, Denise, for having me. It was a pleasure. And I always love to be reminded of things that are important to share with my clients, too.
So, ladies and gentlemen, rather than a neighbor-to-neighbor tip today, I'm going to give you a what the HOA. I have had several people talking to me about they want to know some of the funny stuff that we deal with regularly in an HOA. So this is some of the just funny, ha-ha. Don't take it too seriously. In the heat of the moment, we have the most empathy for the homeowners who are going through it. But when you get away from it and you look back, it can be kind of funny. So there was a time, gosh, I don't even know how long ago this was. One of the managers that I had worked with in another company had a homeowner physically bring in a bag of dog poop because she wanted us to do DNA on that dog poop and violate the neighbor or the owner of that dog. But she wanted us to see that the dog was actually pooping on her lawn, and she wanted us to figure out who it was. Now, in today's world, they actually do have DNA testing that you can do for dog poop. But if you live in an HOA, and for those that support HOAs, it is common for us to talk about dog poop every single day. We talk about poop, pools, parking. Those are the most common conversations we have every day. But I will never forget the look of the manager's face when she was handed this little bag of dog poop and asked to please take care of it and find out who this dog is and stop them from going to the bathroom on their lawn. So that's today's What the HOA. I look forward to you joining us on another episode of Hey Neighbor. Thank you for joining us for this episode of Hey Neighbor. Subscribe wherever you get your podcasts for more insights on building better communities together.